people get lulled into a false sense of security that because our two tax regimes sound roughly similar, because we both speak broadly the same English, that our tax rules will work the same. And that's why it's so important to have advisors connected in the way that we're doing today, because it allows you guys to spot when clients are talking about these big money transfers. Well, the client's thinking about bringing money into the UK because they want to buy a home. Maybe they're liquidating some of their portfolio, or maybe they're saying to you, my folks back in the States are transferring me the money. You guys can say, well, can I just check, how is that money arriving here, and what was the source of the money in the US? Just because we want to make sure that you get to keep as much as that money as possible, and HMRC gets less, otherwise you have less money to spend on your house. Welcome to the US UK Tax Talk podcast. Today we're going to do things a little differently. I'm going to be a guest on my own show. I have the pleasure of being joined today by Nathan Pryor and Kat Smilewicz of Partners Wealth Management. Kat and I are going to talk about a number of things relating to the tax changes that came out in 2025, and Nathan has very kindly offered to be our guest host. Nathan, Kat, thank you so much for joining me. I guess, Nathan, as the host, why don't you introduce yourselves and tell everyone a bit about Partners Wealth Management?
That's great. Well, thanks, Aidan. Thanks for having us here, and delighted to be your first guest host. Fantastic. Yes, why don't I tell you a little bit about Partners Wealth Management first, just for your listeners. Partners Wealth Management, we are a independent financial planning practice. We specialise, my team, in giving international advice, i.e. to clients who've got cross-border considerations. Kat and myself specialise in working with US clients. So that's people who have got US tax considerations. It might be citizens, it might be those with assets there. I've been working with US clients for about 20 years now. So got a good bit of longevity and historical knowledge there. Kat, do you want to say a bit about yourself?
Yeah, thank you again, Aidan. Very nice to see you, and thank you for inviting us today. So, as Nathan mentioned, we work together on the international team at PWM. I am a partner dealing with cross-border considerations, particularly with US clients. So that's the topic that has been concerning us recently, has been connected with all the changes introduced recently, and especially affecting, I'd say, probably about 70% of our clients.
So this is where it gets really, really scary, because I usually have a list in front of me of the things I want to talk about. But beyond knowing, Nathan, roughly what topics you want to discuss, this is me officially handing over the reins of power to you. So I'm just going to sit back and enjoy being a guest for the first time.
I can ask anything. Well, I thought I'd start off with, obviously we're here because we wanted to talk about the new changes to the UK tax regime for people who have come to the UK. But particularly, we wanted to look at how this has impacted Americans who are here in the UK. So I thought I'd just give us a quick reminder that the reason we're thinking specifically about Americans differently is because they still have their US taxation, even though they might be UK residents. So they have two jurisdictions to consider. However, when the UK tax kind of kicks in, I guess, is a question mark for some people. And so I wanted to start off by asking about how somebody might know when they become a UK resident. Perhaps, Kat, do you want to kick us off with that?
Yeah, absolutely. So your tax position in the UK each year depends on where you are resident. For years and years and years, there hasn't been much of a structure there to establish whether you are a UK tax resident or not. Luckily, the Finance Act 2013 introduced a bit of a structure, and that's called a statutory residence test. And that's like a step-by-step method which helps you establish whether you are a tax resident in a particular tax year or not. There are 3 different tests that one should take to establish whether they are the tax resident or not. And the first 2 tests are quite easy, because the first one is like you do the test and you know automatically that you are not a tax resident in the UK. So it's an automatic non-residence test. Then there's a second test, which is an automatic UK residence test, and that kind of looks at Do you have a home in the UK, or perhaps more than one properties in the UK? Or do you work full-time in the UK and spend 75% of that time actually based working from the UK? And then there's a third test, which we refer to as sufficient ties test, and that looks at a number of different ties to the UK. So you would look at things like, do you have a family link in the UK? So is there someone close to you living in the country? Do you work from the UK? Do you have a property in the UK? And also how many days you spend in the UK? And you'd think that it's quite a straightforward, easy-looking, step-by-step method. But actually, the guidance document prepared by HMRC I think it's about 200 pages just talking about how to establish whether you spend a day in the UK or not, because you might be looking at what time you were in the UK, for example. So it's really, really tricky, but at least there is a structure. And there's some other complications, and I'm sure Aidan will gladly cover those as well.
Very happy to. I think the thing I always say to people is, it is an objective test, which means if you give me perfect facts, I can give you the perfect answer as to whether you're resident or not. But that doesn't mean it's a straightforward test. It is a relatively complicated black and white test. And lots of people want to know with great specificity exactly when they're resident. And that's totally fine. We can give them that specificity. But I'm going to need quite a lot of information from you to do that. The first complication I think that it is worth focusing on is when tax residency starts, because most people in this country don't come to the UK on exactly the day of the year that we want them to come. Or if they do come on that day, what do you count as them coming here? Well, what if they came here 3 weeks prior to scope out some properties? And so the thing that people need to realize is that UK tax residency status is levied on a tax year basis. So if you trigger the UK tax residency rules that Kat correctly identified, you are resident on a tax year basis. So even if you come to the UK in June, by default, you are resident in the UK from the start of that tax year, from the start of the 6th of April. That can surprise some people, particularly if they come to the UK from abroad and maybe they come over the summer, or they come for children to start in schools in the UK in September. And then they're met with the surprise that maybe they end up being tax resident from a period almost 6 months prior to when they even first came to the UK. And so the UK does have this concept called split year treatment, which recognizes the fact that someone comes to the UK halfway through a year and we can divide the year into a sort of resident and non-resident part. It is not absolutely certain every time that it will apply. It is, again, a facts and circumstances case, but you want ideally to have your year split in two if it's going to make a material difference to you, because maybe something happened in the earlier part of the year to cause you to want to avoid tax on that foreign source income and gain, for example. There is then a second way that particularly, let's say, Americans coming to the UK might want to moderate their UK tax residency exposure through various provisions under the double tax treaty that we have. It is possible, certainly as a matter of US law. I say this, no one around this table is currently a US tax advisor, so everything we say here is prefaced by the phrases, we understand that. But by virtue of being US citizens, you are income tax residents of the US, and so it can be the case that someone is a tax resident of both the US and the UK at the same time. And the double tax treaty has a number of provisions that say that both countries aren't allowed to tax you on the same income in the same tax year, etc. One country should give credit, or there should be some other kind of mechanism for determining which country has the right to tax. And there are a series of provisions in Article 4 of the treaty that refer to what's called treaty residency status, which is a way of determining if someone is resident in both countries under each country's domestic rules, which country has the right to refer to that person as a resident, and we refer to that status as treaty residency status. And there's a series of very, very exciting tiebreakers that you go through step by step to determine, which country wins on each game. But if it's a tie, if it's a score draw, you then move to the next test, and then you go again. And then eventually, if you get to the very, very bottom of that test, the answer is HMRC and the IRS have to get together and they have to decide between them, and you never want to leave it to that position. So there are a couple of additional ways to moderate the impacts of what would otherwise be tax residency status from the 6th of April. But, and I'm sure you guys will agree, and this will, I'm no doubt, feed into some of the things we talk about later, let's get it right from the beginning. If we can avoid becoming tax resident at all, or we can control from the date from which we become tax resident let's work on that presumption rather than trying to rely on one of these defences applying.
That's great. And the reason I wanted to kick off with talking about tax residence is that the new regime in the UK for considering how individuals are taxed when they first come here has changed from this concept of domicile, which I don't think we'll get into too much today, to this concept of residence, which therefore triggers when you might be subject to tax in the UK, and then starts a timeline there going forward. Some of the key elements to the new regime, the foreign income and gains regime, or FIG regime, as some people are calling it, is that for the first 4 years of being in the UK, you might not have to pay tax in the UK on your foreign income and gains. There's also a consideration around inheritance tax, that perhaps for the first 10 years of being in the UK, you don't have to be subject to inheritance tax on non-UK assets. Sounds really interesting, sounds really good. Surely there's a clear win here, but maybe there's some downsides as well. Kat, do you want to give us a bit more detail on the FIG regime from a planning point of view?
Yeah, absolutely. So the FIG regime is also quite a new concept, newer than the statutory residency test. It was only introduced last year, so April 2025. And it gives individuals who are eligible for the FIG regime a temporary exemption on their UK tax. And the period that they are exempt for is 4 years, as you've mentioned. But again, going back to Aidan's point, it's 4 years from the tax year when you become a tax resident in the UK. So you have to be very careful on when exactly you come. And remember that you always go back to that 6th of April, so the beginning of the tax year. And who is eligible for that regime? So it will be individuals who come to the UK and haven't been in the UK for the 4 years in the last 10 years. But it could be foreigners, so it could be Americans that we work with a lot, but it could also be UK citizens coming back to the UK. So it applies to both groups of people.
And I think it's quite helpful, I think, for clients to have some certainty as well around the rules. I mean, you joked about domicile, and we won't get into it today, which is a shame because we lawyers, we loved domicile. It was such a esoteric and weird area of law with nebulous case law dating back over 200 years. I mean, it's an absolute lawyer's delight. The advantage of the new rules is that they're objective in nature. We can say with absolute clarity, Kat is exactly right. You're either a beneficiary of this new regime, you're a qualifying new resident, or you're not. You've been a resident of the UK in the last 10 years, or you haven't. And therefore, this applies to you. Whereas under the old rules, even though under the domicile and the old remittance basis rules, you maybe had 15 years of living high on the horse, whereas now you've got sort of 4 and 10. If someone came to me and said, am I a domiciliary of the UK? My answer was always going to be slightly qualified because, well, it's a subjective test and I might say you are, but HMRC might say you're not. And that would apply even more for someone leaving the UK because I might say with confidence, yes, of course you intended to leave the UK and never come back after only 5 years, but are HMRC going to really agree with you on that? So I think the other advantage to it is just that peace of mind that you can plan. And I imagine planning is where we're going to come to on this podcast episode. And that really shouldn't be dismissed as a value as well.
I think the other thing just to kind of consider in this is that, Kat mentioned about you've got this kind of 4-year tax holiday as such, but it might not necessarily kind of help with all of your assets, and even assets that you think are not UK assets might still be taxed even if you are using this regime. Can you give us a bit of input on that?
Yeah, so it's a good point you raise, which is the foreign income and gain regime is so called, it's going to surprise everyone because it's based on foreign income and gains. And so you only get that benefit on income and gains if they are foreign citers. Now, what counts as a foreign citer's income and gain is a lengthy and very exciting technical discussion, but if you are a resident of the UK and you work in the UK, but you work for your employer who employed you before you came to the UK, maybe it's a US employer, just because you're still working for that US employer doesn't mean that what you've got is foreign sourced income, for example. You might not hold your assets in your own name. You maybe hold your assets in a trust. That's very common for a lot of Americans. And just because you might have been eligible to claim foreign income and gain relief on assets held in your own name may not necessarily mean that you hold assets in that way for the purposes of the trust's assets. And so it really is important. This is, I think, why we're having such sort of a good discussion today, to have this review before you start triggering those UK tax residency rules. Because once you come here, as Kath exactly said, it's 4 years from the point at which you first became resident. It's not your first 4 years of residence. So if you come to the UK in October, but you were resident in the UK from a tax perspective from the 6th of April, you might have already lost 6 months of your 4-year regime. You've already lost 1/8 of your regime. If you then left the UK the following year, or you inadvertently triggered residency status in a year you hadn't expected, it might be that you've actually lost some of that really valuable planning time. So taking the opportunity to work with your financial planners, to work with your lawyers, to work with your tax advisors, to work out, what do I have at my disposal? Which of these things is likely to be protected by the foreign income and gain regime? Which of these things, and maybe we'll come on to it, which of these things might I want to convert while I'm not a UK resident? That's going to pay dividends figuratively and metaphorically in the long term, because you're not trying to organize your house while you're inside that 4-year regime. Do it before you get here.
I think one of the things that importantly you mentioned there, and I just want to pick up on and emphasize, and I think you've both kind of hinted at this, but the old regime, the kind of domicile regime, UK citizens who were returning to the UK were kind of excluded from that. The new foreign income and gains regime, it's kind of opened that up to say, actually, if you're a UK citizen, you've been living abroad, working abroad for the last 10, 15, 20 years, and you're coming back to the UK, this applies, doesn't it?
It's really, really useful for returning British expats. I think under the old rules, sometimes purely by dint of your birthplace and sort of nexus to the UK, or the nexus of your parents to the UK, you could have been treated as what was previously referred to as a formerly domiciled resident. And on returning to the UK after maybe decades and decades of time abroad, you were hit by the sort of the full force of the UK tax regime, frankly, within the first 12 to 24 months of coming back to the UK. Now, those of us around this table acting for returning British expats, if they've been in the US for 20 years and they're retiring back to the homeland, they get the same benefits as everyone else. So it's not really fair to say that it's a foreigner's regime anymore, which the sort of domicile status was. It's more a kind of a new arriver, or a relocating newer person, and that is a real value, because it now means that British expats, like every other person coming to the UK, whether for a long period of time or they've been away for a long period of time, they get the same benefits as everyone else, which surely must be the right thing.
Yeah, good. And just to kind of hone this in a little bit onto US citizens, US taxpayers coming to the UK. I mentioned at the start, they still have to pay their US tax. They're still US tax filers. So why do they care? If I'm going to pay tax in the US anyway, okay, I'm not paying UK tax, but do I care? Kat, any thoughts on that?
I mean, absolutely. There are a lot of benefits for US residents coming to the UK with this new regime. And one of the benefits is that, for example, taxes in the US tend to be lower than taxes in the UK. And that's why you might choose to pay those taxes for a longer period of time. So, for example, 3.5 years, you might still want to pay your US taxes. Another thing is you might have some specific portfolios, investment portfolios in the US that might not necessarily be compliant with UK tax regulations. So that gives you time to decide, okay, do you want to liquidate your assets, or do you want to perhaps restructure them and move from quite often in the UK we refer to as PFICs, so passive foreign investment companies that US citizens quite often have within their portfolios. You might want to move them into non-PFIC funds. And also you might want to decide to have assets that are reporting in the UK. So there are a lot of tax considerations on both sides, the UK and the US, and the extra time gives you a chance to have a chat to a financial advisor, have a chat to a tax advisor, a lawyer as well, and make sure that before you decide that, okay, I'm ready to pay UK taxes on my foreign income and gains, that they are structured in the most efficient manner.
I mean, I'll only add two things to what was otherwise, I think, an excellent answer from Kat. One is certainly compared to the old regime, the remittance basis regime, and I know you both remember the time well as well, not paying tax in the UK because of the remittance basis wasn't the be-all and end-all, because you were only deferring the point at which tax was going to arise. And then we had to get into really exciting conversations about segregation of income and gains, and what if someone remitted the income, and did that count as a remittance, and what if you paid off a credit card using a US account? And the remittance basis rules were really complicated, and the only people that made out like bandits were the advisors having to advise on these things. I joke. But the other thing I want to say that's interesting, and I've had particularly people from high tax states in the US relay back this to me. This wasn't something I thought of. They thought of it and told me. It was one of the advantages of the FIG regime is those individuals from states like California and New York are always going to be exposed to federal US tax. So that baseline of tax is always going to apply in the US. But if they're moving from, say, New York to the UK, then for that 4-year regime, they may well no longer be exposed to state income taxes because they have lost their relevant nexus to that particular state. They've lost their New York domicile. And so it could actually be that their overall burden of tax comes down because the rate of tax they're now paying, at least for that 4-year period, is only US federal tax, as opposed to US federal tax and New York state tax, and there's no UK tax to worry about at all. Whether after the FIG regime has ended, they're actually in a better position is also different, because is the difference between US federal and UK tax more than the state equivalent? That matters state by state. But I have had clients who've come to the UK out of high tax states like New York, specifically for the purpose of realizing some stock or something like that, because they don't want to pay US state income taxes. And so they actually use the UK as a sort of temporary low tax jurisdiction, as a place to come, realize their investments, spend a few years here, maybe try before they buy, but doing so out of the shelter of the state tax regime rather than the federal regime.
Yeah, it's an interesting structure that we've ended up with, and certainly lots of opportunities for things like that. I want to move on slightly into kind of thinking about the planning that somebody should do, the things they should think about before arriving to the UK. Yes, we've got this 4-year window, and 4 years sounds like a really long time, and it's fantastic, but we've already discussed how you might lose a little bit at the beginning, you might lose a little bit at the end, maybe it's only 3 and something years.
This assumes also that the first person you talk to after you land at Heathrow is your financial advisor or your lawyer, and whilst I think we're all very important, I don't think we're that important.
Perhaps not. So let's think about what you should be thinking about before you arrive. And Aidan, I thought let's start off with thinking about some of those assets, some of those structures that actually on arrival, it might be already too late.
Yeah, no. And this is probably the single most important thing these days for Americans coming to the UK to consider. It's things that aren't covered by the FIG regime, one of which is trusts and one of which is companies. Those are the two things I talk to most people about. Putting aside, well, if you don't come to the UK, you haven't got to report it. You might, have to report it under the FIG regime. So there's a generic benefit to not doing things while you're under the cover of the FIG regime. But the two things I talk to clients quite a lot about are avoiding your trusts and avoiding your companies becoming UK tax resident, because neither of those are things that are protected by the FIG regime. So if I'm someone who is the trustee of my own trust, whether it's a revocable living trust or it's another sort of trust, if I come to the UK, my status now as the grantor of that trust or the sole trustee of that trust may cause the exposure to UK tax on that trust to be very, very different from when it was entirely based in the US and when I was entirely based in the US. And so it's really, really important that those people take advice prior to triggering UK tax residency status for the first time as to what the consequences are of them coming to the UK, not least because trustee residency status and distributions from foreign trusts are one of the sets of rules that don't respect split year treatment. So if you come to the UK and claim split year treatment saying, oh, it's all okay, in May I took a whacking great distribution from my family trust before I came here, that's one of the things that the UK is still going to tax on a tax year basis, even though you were on a split year basis. So it's not good enough to rely solely on your split year rules, for example. The other thing is companies. Companies and where they are resident is a sophisticated and muddy topic, a bit like the domicile rules that are still based in centuries of case law in the UK. But it is entirely possible for you to accidentally import your company into the UK and centrally manage and control it, to use the expression, if the strategic decision making takes place from the UK. If you are the sole director, if you're the sole manager of your LLC, or if you have a C Corp with a board that is accustomed to acting in sort of accordance with your directions, then that company is centrally managed and controlled from the UK, and that company's worldwide profits are exposed to both UK taxation, UK corporation tax, and UK corporation tax reporting. And that can be really, really fiddly for those people that either run their own businesses, or they just happen to use one of a plethora of US corporate structures for holding assets. Maybe they hold real estate in an LLC. Maybe they hold their US investments in a particular corporate structure. Getting those kind of holding structures reviewed before you come to the UK is perhaps more important than having the individual holdings that Kat mentioned earlier on being reviewed, because Kat is right. You can at least churn those or turn those over in your 4-year regime and be sort of confident that you're protected from UK taxation under the FIG regime. That's not the case for trusts and companies, and those really, really ought to be sorted out before you come here.
Kat, I guess with that in mind and slightly broadening out to think about how somebody might prepare for arriving to the UK, what else would you generally be talking to people about on kind of pre-arrival conversations?
Yeah. So, I mean, as Aidan mentioned, one of the first things people should be doing when they decide that they want to move to the UK is speaking to all their advisors. So it will be a tax advisor, it will be a lawyer, and ideally speak to us as well, financial planners. And the reason behind that is that we can help them build a proper financial plan. So we can help them decide step by step what are the actions that they should take before they come to the UK. I'd say probably about 90% of the clients that we start working with start with having built like a wealth model, a cash flow model. And the great thing of working with tax advisors and lawyers is that once they've reviewed those different structures that clients have, for example, the companies, the trusts, we also look at the individual assets that they hold. So be it US pensions, be it US portfolios, and we can incorporate them into that plan and decide, once we've understand that taxation, how money can be paid out of those different structures, we can then see what steps should be taken. So, for example, a person might want to move to the UK and buy a house in the UK. So looking at the financial matters, we know, is it better to draw money out of a trust, or is it better to perhaps take income in the US whilst you are still subject to the FIG regime, because that will be more tax efficient? So building that plan, but understanding the different structures and the different portfolios and assets that they hold enables us helping clients making the most tax efficient decisions.
The number of times I've had discussions with clients who have come to the UK, maybe they've been in the UK a couple of years already, maybe they had come to the UK a couple of years before the 2025 changes came in, so they only have like a year or 6 months left of their FIG regime. And I say to them, I don't mean to put too fine a point on it, but to the point that Kat exactly made, you've got 6 months left of being able to withdraw money really efficiently. How long do you think you're going to stay in the UK for? Let's say you think it's another 10 or 15 years. Can you realize the funds out of pensions, out of trusts, out of somewhere else now? Because to try and realize it later is going to mean you suffer UK income tax at up to 45%, for example. You know, I'm now asking you to really try and advance as much money to yourself as possible, or request from your family's trust as much money as possible, because the going is never going to get as good as you've got it right now. And that does set hairs running sometimes, but take advantage of this new rule that's here. Otherwise, you're going to regret it when it's gone.
Yeah, it's difficult, isn't it? Because we're asking clients to think about things many, many years into the future, and they might only be coming to the UK because they've got a job posting and they think they're only going to be here for a few years, but we've all seen people then have families and still be here many decades later.
I've joked before on this podcast, my mother is an example of this. My mother came for a junior year abroad while she was at university. She met a man here that turned out to be my father. Sorry, didn't turn out to be my father. He was my father. He still is my father, I should stress. And she's been living in the UK for probably several decades. I won't say exactly how many to spare her, but she's an example. I am here because she decided to stay in the UK. I don't imagine she would have intended to stay in the UK when she first came here back in whatever year she came here. I'm not going to say.
Yeah, no, quite. And I guess something that I'll kind of tag on to this then and just kind of ask your thoughts about then is when thinking about people coming to the UK, building that financial plan, Kat, thinking about, what cash do you need to live during these 4 years whilst you're here, kind of stretching that further out. And again, it goes back to looking at the structures that they've already got in place and seeing how best to utilise them. Inheritance does come into that to some degree, maybe more for some clients than others. Aidan, perhaps just briefly, what kind of structures might people have that are quite attractive to maybe try and protect when they come to the UK?
Nathan, you don't have to tease me with the question I like. So we spent a lot of time on this podcast thus far talking about all these horrendous bear sort of traps and pitfalls that people should avoid. And, we run the risk of giving the impression that you can't come to the UK with anything to your name because the UK is just going to try and tax you. The thing that changed in the 2025 tax changes were largely rules around self-made wealth. When you put money into a trust yourself, or when you have foreign income and gains that are attributed to you, and so on and so forth, what have not changed and thus are, relatively speaking, more efficient structures are structures put in place for you by family members who are themselves foreign or remain foreign themselves. So if I am the beneficiary of a trust, for example, maybe my folks back in the Midwest set up a trust for me, or my grandparents created a trust on their deaths or something like that, that money held in that trust for my benefit may be extremely tax efficient. There may be no UK tax at all until money comes out of that trust to me. That trust may be what we refer to as an excluded property trust for inheritance tax purposes, meaning no UK taxation on anyone's death, provided that trust doesn't invest in UK assets, and no income tax or capital gains tax on any activity in that trust, unless or until I decide to draw down. A bit like how we think about pensions in the UK sometimes. And that can be an immensely beneficial structure for someone living in the UK to think about. Gosh, well, I know that sort of line of credit, that resource is there which I can draw on if I need to, and I know that I'll pay tax at that point. Maybe even more ideally, I can talk to the trustees about the ways in which that money can come out of that structure. Maybe I'm even one of the trustees myself. That's not to say that that sort of trust doesn't come without pitfalls. There can be, accounting costs to it. Having to calculate and compute what the actual tax is something our lovely tax advisory friends that are not present on this podcast would want to jump up and down to do. But, these structures that are put in place for you tend now to be those sort of remaining repositories of tax efficient wealth. It's those self-made structures that tend to be the ones that the 2025 tax changes attacked. And so it's those ones that I think we'd all agree are the ones that clients should be particularly considering before they come to the UK.
Yeah, and I think it's important there to try and delineate between different types of trust, different types of structures, because they can be very different in terms of how they're considered and treated when you get here. And Kat, just I guess going back to something you mentioned about thinking about people buying property here or onshoring assets into the UK, this probably cuts into that a little bit in terms of decisions that people can make at this point to just help them perhaps defer how much asset kind of comes into the UK, becomes subject to UK taxation, be it income tax, inheritance tax. Are there some kind of key things that you tend to focus on or would highlight to clients to consider?
Yeah, so I actually had a case recently of US couple coming to the UK, and I feel there's been a bit of a trend recently, last few years, and they were both quite successful professionals. So they've built wealth over time. And I feel the main questions were actually about buying a property. They actually did have a house in the US, and they wanted to buy a property here because the plan is to stay forever. We'll see if the weather changes their mind or not. But they both had quite significant investment portfolios. Both three portfolios were managed by US wealth managers with little consideration, which obviously in that case was quite self-explanatory for the UK, because obviously, they were not linked to the UK at all at the time. And the main thing that we do with people like that who come to us with significant investment portfolios, we need to look at what type of holdings they have within those portfolios. And I think I mentioned before that one of the important things in the UK is that if you want to make sure that you are taxed efficiently, you have to hold UK reporting funds in the portfolios. So restructure is one thing, but also if you need money for buying a property, we can consider things like going back to the financial plan. Are we just selling those assets and reinvesting? Or perhaps we know that they are keeping their existing job in the UK, staying within the same corporation, but just being relocated. Then perhaps they might have an option of taking a mortgage in the UK. So there are different things to consider, but kind of affordability in the UK is quite important as well.
One of the things that Kat said has reminded me of the issue that often comes up in US-UK planning, which is, and house buying tends to be the reason it comes up most frequently, about assumptions as to how and when UK tax will arise based on people's conception of how US tax arises. So when someone wants to bring, let's say wants to bring $1 million to the UK, or someone's going to give them $1 million, or someone's going to loan them $1 million, that the way in which those funds are going to be generated in order to pay for the home in the UK tax rules ought to follow what the US rules say. And that's just not always the case. I mean, you were saying before, Nathan, about different structures having different characteristics for different tax purposes. Well, revocable living trusts, for example, are a really good example of taking $1 million out of a bank account held within a revocable living trust could have wildly different UK tax consequences compared to the US tax consequences. Money being held in an LLC will have different consequences for the US and the UK if you withdraw it. Even something as simple as your parents loaning you money to buy that house could have a dramatically different consequence in the UK, because that person in the UK might not realize they've just now given their parents $1 million inheritance tax exposures, or rather 40% tax on $1 million inheritance tax exposure in the US because of our relevant loan provisions. I think people get lulled into a false sense of security that because our two tax regimes sound roughly similar, because we both speak broadly the same English, that our tax rules will work the same. And that's why it's so important to have advisors connected in the way that we're doing today, because it allows you guys to spot when clients are talking about these big money transfers. Well, the client's thinking about bringing money into the UK because they want to buy a home. Maybe they're liquidating some of their portfolio, or maybe they're saying to you, my folks back in the States are transferring me the money. You guys can say, well, can I just check? How is that money arriving here? And what was the source of the money in the US? Just because we want to make sure that you get to keep as much of that money as possible and HMRC gets less. Otherwise, you have less money to spend on your house.
There's plenty of unknown unknowns.
Another quite interesting question we do get from clients is the timing of selling the US property. It would seem that normally it's best to sell before you move to the UK, but actually now that you have the 4 years or four tax years to deal with the sale, you might actually be better off selling the property once you're in the UK, avoiding, for example, state taxes.
On the flip side, though, so I had this exact question about 6 months ago from a client. That client was interested in some of the statutory residency test rules that we were talking about earlier on. And if you sell your home in the US, that might affect you for the purposes of the automatic tests in the UK and making you automatically tax resident. That might also affect you for the purposes of the treaty tiebreaker rules I mentioned previously, because the very first question is, do you have a permanent home in both countries or in one country? And if you sell your US home and then buy a UK home, you might end up having your only home in the world in the UK, and the UK automatically wins the treaty tiebreaker test. So I completely agree with you. The FIG regime is quite useful because it means we don't have to worry about the UK tax consequences of selling foreign assets. But the existence of those foreign assets might actually be useful in terms of structuring the impact of UK tax on a sort of more fundamental basis, which is why, again, we come back to the theme of take the advice before you come, rather than arriving here thinking, oh, I'll sell my house now, and then sort of asking the question, was that the right way to do it?
Don't rush in. I want to focus on some positivity. I want to think about the benefits of the FEG regime for US citizens coming to the UK, or indeed Brits who have returned to the UK from the US. Thinking about the various assets they might have and accumulated on arrival here. We've probably touched on some of them lightly, but perhaps we can go into a little bit more detail. Kat, can you kind of give us a run through of perhaps some of those things that during that 4-year window or 4 tax year window, clients should really be thinking about doing, how to make the most out of that? Where are the benefits for them?
Mm-hmm. So I think one of the things that I've mentioned, especially for US citizens, there might be other countries in the world as well, but it is the fact that taxes in the US tend to be lower than taxes in the UK. That's why if you're benefiting from the 4 years of being able to select where you pay your taxes might actually mean that overall your net position is better. Then secondly, that gives you time to perhaps draw your US pensions whilst you're still in the US. Well, you are in the UK, but you're still exempt from the taxation in the UK. So I think these are kind of the main 2 that come up to my mind. Anything else, Aidan?
Well, you were mentioning earlier on that one of the advantages of the FIG regime is it provides you cover for churning through certain assets. So if we have US mutual funds that don't carry UK reporting status, we can sort of divest ourselves of those assets without worrying about incurring those higher rates of UK tax. But there are lots of things that generate mismatches in the sort of US and UK tax rates. I mean, please either of you correct me if I'm wrong, but dividends, qualifying dividends in the US are taxed at a much lower tax rate, for example. I think they're taxed at 20% in the US. We don't have an equivalent qualifying dividend tax rate. You know, you're going to get the full whack of the dividend income tax rate in the UK, which is as good as 40%. So someone in the US who is accustomed to paying 20% income tax, and maybe they live off of those dividends, maybe that's a really integral part of their the sources of their day-to-day expenditure coverage, suddenly being told your tax rate is as good as doubling is really quite detrimental to them. And, you know, that cover of that 4-year period we joked about previously to kind of maximize your returns while you're protected is still incredibly important. So it's not just the products themselves, it's also the assets in question. We talked about selling homes or selling assets. Generally speaking, most Americans are eligible for greater levels of deductions or reliefs against their gross income and their gross capital gains than they are in the UK as well. We just tend to hit people with the full tax rate with very little offset. Whereas in the US, I'm constantly staggered as to the sorts of things that Americans can deduct off of their gross income tax. So what might look comparatively like broadly similar tax rates. You know, the rate of capital gains tax in the UK is 24%. In the US, it's usually 23.8%. You know, those look at the sort of the top line relatively similar. Once you dig down into the actual rates of tax, you can find that point that Kat made about the US rate being lower, not just being the headline rate, but also just the actual amount of pounds and pence or dollars and cents tax you're paying being that much lower. So it really, this is why it's so great to have you guys on, because it really, really pays to have that thorough line-by-line review of the financial plan to check, are you actually maximizing your resources and drawing down from your accounts, your resources in the most efficient way possible? Because otherwise you're going to get caught short.
And I think also just deepening into that, I think in the old kind of regime when people did get advice before they arrived, you know, Kat might have looked through the portfolio and gone, oh, you've got these horrible funds that are not going to be taxed efficiently in the UK, or you've got your assets, etc. They've now got 4 years to decide either when to do it or to spread it out. It's not an all or nothing anymore. That must be quite valuable.
I mean, the comparison I give sometimes is to, again, the old regime. You know, I used to have clients who'd come to the UK and naturally assumed that the remittance basis was what they wanted to elect onto because it was free when you first started and, hey, tax deferred is tax saved, except for the fact that as an American, all you're ending up doing is increasing your risk of double taxation because when you then remit those funds in year 3, you weren't going to get credit in the UK for the tax you paid 3 years ago in the US. And the number of times I had clients with general investment accounts or specific US products like UTMAs that sort of claim the remittance basis for a couple of years or maybe even up to the full 15-year period before realizing that wasn't necessarily that efficient because now I have this account that's locked away in the US and I know if I bring money out of that account into the UK, I'm going to suffer potentially 45% tax further than I already paid on that money when it was in the US. It creates this kind of black hole in the financial plan of money that can't be used unless you're spending it incidentally outside the UK. But if your life is in the UK, you've moved your family here, etc., what are you supposed to do with that account? And this used to really, really worry clients about how you manage your funds effectively when so much of this money ended up being locked away outside the UK. Now, the UK has provided a new facility for this, and it might be that we come to talk about that in the remaining time left, that allows people to kind of unlock the release valve on some of these funds slightly. But that's a real benefit to this new regime, is we don't have that hangover anymore of, oh, well, I didn't pay tax on it in that year, so I'm now just going to pay tax instead in this current year. The remittance basis was available for a longer period of time. We've kind of taken that kind of 15 years and we've shrunk it down into 4 much better years. And I try and be more positive to clients when they complain about having lost 15 years. I say, yeah, I accept that. But if you were coming to the UK now for the first time, I think in those 4 years, working with a firm like Partners Wealth Management and Collier Bristow, you can probably get more done simply and tax efficiently in those 4 years than the kind of noose hanging around your neck you'd have ended up leaving for yourself after 15 years on a remittance basis.
Yeah. And I think the important bit here is I kind of try and emphasize to people, don't think of 4 years as I've got time to think about it. I think those need to be active before you get here and an active 4 years to make sure you are making the benefits of it, using allowances, thinking about, simple things like converting your portfolio into being dual tax efficient, thinking about using, you're here in the UK, use your ISA allowances as small as they might be, think about, should I be doing UK pension contributions as well as having my old US pension, etc., etc. So I think these are all things that we should kind of have in mind and think about. In the time we've got left, I think we'll try and capture some of the other things and think about. We've touched on these new rules. They're not necessarily just about new arrivals. There are people who have been in the UK for some time. There are people who have had time previously on the old remittance basis. There is a big change for them. Perhaps the future is no longer what they thought the future might be like, but there are a few little nuggets in there that could be quite interesting. Aidan, why don't I let you kind of kick off a little bit and tell us a bit about, we're now knowing as the Temporary Repatriation Facility.
TRF. The TRF, everyone's new favourite 3-letter acronym, the TRF. So one of the quid pro quos for kicking people off the remittance basis was accepting that people might have carried out some perfectly sensible long-term planning, assuming the remittance basis was going to be available. And so as a nod to those people, the UK government, in removing the remittance basis, said, well, okay, we're going to give you this temporary ability to repatriate funds to the UK, which, for what it's worth, between us three around this table, I think is an incorrect definition, because you're not repatriating money because it was never here in the first place. You're just patriating the money. TPF wouldn't really have made as much sense, I think. So the Temporary Repatriation Facility is a way for UK residents to take money that was previously protected under the remittance basis regime in a year in which someone elected for the remittance basis regime to apply and didn't remit and haven't since remitted that money to the UK, to bring that money into the UK at a much lower rate of tax than they would otherwise have done. So I take my client I mentioned previously, who had a large investment account previously protected under the remittance basis, and I said in a worst case scenario, in bringing that money to the UK, they would have been exposed to UK tax at up to 45%. The UK government has now said, if you bring that money into the UK in the current 25-26 tax year or the 26-27 tax year, you'll only pay a rate of tax at a flat rate of 12%, or if you bring it to the UK in the third tax year, you pay a rate of 15%. And the idea being it's supposed to encourage people to take that money that was locked away overseas and to remit it to the UK at a much lower rate of tax. And that can be incredibly advantageous for clients that either have large portfolios overseas that have spent a long time on the remittance basis, or people who came to the UK. Sadly, the door is shut already, but those clients who, came to the UK and in their first 4 years tickled a bit onto the remittance basis and then tickled a bit onto the FIG regime and maybe, made hay under the remittance basis, took as much as possible, claimed the remittance basis, and now have the benefit of 3 years under which they can bring that money into the UK. Again, it's a tool. It's a tool that we can use with the right clients. But for those clients who are sitting here with their head in their hands thinking, well, I've been here 9 years. I thought I was going to get 6 more years of the remittance basis. The answer is, I'm afraid you don't. But for those 9 years that you were on the remittance basis, and this isn't unique to Americans, you now had this opportunity actually to bring that money to the UK that you thought you maybe were never going to be able to. So for the client buying the house or the client looking to fund children's education, you can probably do that at a 15% tax rate rather than a 45% tax rate.
Yeah, I mean, it could be a fantastic opportunity. As we've said earlier, people often come to the UK, think they're only here for a few years and find themselves still here multi-decades later, having potentially parked assets offshore under the remittance basis, which now would be really painful to bring back in. Kat, when we're looking at clients like this, they might have a big asset offshore that they can pay that 12% to bring it into the UK. How do you work out whether they should pay that 12% and bring it to the UK? How much do they need? What do you do?
So, I mean, it's actually the TRF is a very, very interesting facility because, first of all, you don't actually need to sell the assets. You don't need to bring the assets to the UK. You just it's a straightforward designation of assets, and you don't need to separate income, gains, and capital. And in order to decide what you're actually bringing, I think I'll be going back to that, being in a financial planner's shoes. I would recommend that you do go through consultation with a financial planner and build that cash flow model together.
I mean, I will say one thing on behalf of the tax advisors who are sitting, and if anyone's really paying attention and is starting to slightly tear their hair out, one thing I've been told about the TRF and the designation point, which I don't think has been resolved yet by anyone, which is whether from an American's perspective, they do actually have to bring the money into the UK, because I believe in order to claim a foreign tax credit in the US, it can't be a voluntary tax you're paying in the third country. And if you designate funds as suffering the TRF in the US, but don't bring them to the UK, will the IRS consider that you're paying that 12% tax on a voluntary basis, and therefore you're not eligible to claim a foreign tax credit for that 12% against your US tax exposure? I think this is kind of an elaboration of the remittance basis charge and the question that existed, and I forget exactly when it was resolved by the IRS, shockingly recently, about whether you should get credit in the US for the remittance basis charge you paid, because the IRS tried to claim for a long period of time you're choosing to pay the remittance basis charge, and therefore it's a voluntary tax, and therefore we're not going to give you credit for the £30,000, the £60,000 that you had to pay. So depending on when this episode comes out and who is intently listening at this point, however many minutes into this episode we are, just check with your tax advisors in the US whether if you just designate the funds, you can in fact still claim a deduction against your US liability. But I'm going to defer, like everyone else from this table, to the US tax advisors on that point.
Indeed. I think it's potentially a great opportunity. It's potentially a very tricky opportunity to find out whether it is positive or not, but certainly something that should have consideration. There is a defined period of time, isn't there? Okay, we'll try and squeeze in one last topic to talk about, and we've lightly touched on it, but it's the estate planning considerations which have changed. Aidan, why don't I let you just give us a quick overview as what is different between the new FIG regime and how that impacts people's UK estate planning versus the old domicile basis regime. It is quite different.
You're squeezing the estate planning part into about 5 minutes into this episode, so I'm going to do this quickly.
2 minutes.
That's fine. I can speak quickly, as a lot of people know. So the main difference is rather than having an up to 15-year non-domicile status protection from inheritance tax, that number has now been cut to 10 years. So after living in the UK for 10 years, the UK government is going to levy inheritance tax on your assets on a worldwide basis rather than on solely your UK assets. So it's a 15-year rule cut to a 10-year rule in effect for those coming to the UK. Now that's problematic for Americans writ large because Americans are used to having a $15 million estate tax allowance and they're now being hit with a £325,000 nil rate ban. There's not a lot we can do about that. There is some relief under the Capital Taxes Treaty, but don't assume you can benefit to a great degree on the treaty. It's not actually that useful in these circumstances. I think there are two things that are important to remind people about, though. One is for people coming back to the UK, the point you made previously, Nathan, who are British expats returning to the UK, and one is about people leaving the UK. So people coming to the UK, if you're a British expat and you've spent 20, 30, 40 years abroad, you are now benefiting from that same regime like everyone else. Whereas if you were a formally domiciled resident, if people can cast their minds back earlier to this episode, an FDR would be exposed to UK inheritance tax in effect from within the first 24 months of being in the UK. And so you got no real protection, despite the fact that you could, for all intents and purposes, be coming back to the UK as an effective foreigner. So you benefit from that same 10-year rule like everyone else. And so, again, good for British expats looking to keep their non-UK wealth outside the scope of inheritance tax. And then the second thing is for those that are leaving the UK rather than coming to the UK. We spent a lot of time talking about people coming to the UK. But for people leaving the UK, you are now subject to that same 10-year rule, or what is more specifically, a 10 out of 20-year rule. And so in theory, UK inheritance tax can follow you on a worldwide basis for up to 10 years after you've left the UK. And so it makes it even more important that whoever is the equivalent of Collier Bristow and Partners in Wealth Management having their discussion in the US about what should our clients do before they come to the US, from our perspective, we want them to know if that person's come from the UK in the last 10 years, it might be that worldwide inheritance tax is still sort of running alongside that client. So be very, very careful at not assuming that just because you've left the UK, your foreign assets are outside the scope. Never quite that straightforward.
Thank you. I'm sure we could spend another good hour or longer on inheritance tax. Kat, anything finally from you?
I think we literally have 15 seconds. So I would say, do always come for advice, because before you decide to move to the UK or make cross-border decisions, speak to a financial planner, speak to a tax lawyer, to a tax advisor, and speak to a lawyer before you come.
Thank you very much.
Thanks for joining us today on the US-UK Tax Talk podcast, and thanks very much to Nathan and Kat for being such stellar guests. My thanks in particular to Nathan for being my first ever guest host. A reminder that we now release episodes on the first Wednesday of every month, so make sure you like and subscribe, and that way you won't miss an episode. Make sure that you also leave a review or comment on the episodes wherever you usually get these episodes, and that way the algorithms know that they should be releasing more of these to more people. You get the idea. Make sure finally to check out Collier Bristow's YouTube page, and that way you can see all of these episodes in our new lovely studio in video form as well. Until then, we'll see you next time.